Hey everybody, Mike Shannon with Keller Williams Realty Group, here with Brenden again from Fairway Mortgage. I'm going to go into a little more depth about the types of mortgages that we summarized in a recent video. Let's start off with the classic, your grandparents' mortgage, as you called it, the 30-year fixed.
The conventional.
The conventional
The
mortgage.
conventional mortgage. So, conventional mortgage, you'll hear a lot of professionals say Fannie Mae or Freddie Mac. Basically, for those of you who are preparing for a mortgage, what you want to look out for with these types of mortgages is for your first timers out there, there's 3% down programs. We call that the Home Ready or the Home Possible. You definitely want to get your credit in order. So that is 720 plus. I know a lot of you use Credit Karma or the Experian apps. Just make sure you have near perfect credit when applying for a conventional. And then, as far as like appraisals and inspections, things of that nature go, the appraisals have a lot less boxes to check. So that's why it's the go-to for most mortgage advisors.
Now, we had talked before about first-time homebuyer programs.
Yeah.
So if I qualify for a first-time homebuyer program with Berks County, Montgomery County, Chester County, the ones that are out there, does that impact my ability to get a 30-year fixed mortgage, a conventional mortgage at all?
No, not at all. So with your local first-time homebuyer programs, most of them have the ability to, I like to call it piggyback on the loan programs. Now there is a Pennsylvania statewide program. We call that the K-Fit for first timers and K-Flex for everybody else. It will piggyback on top of whichever loan program is best for you, the particular buyer, because every situation is different.
Perfect. So one question that comes up, and you hear a lot of mortgages being sold. If my mortgage changes hands down the road, does that impact me at all?
Not at all. When you first get approved, pre-approved, whatever, there is a term sheet, a loan estimate, a cost estimate. It has 1,000 different names. But if your mortgage does wind up being sold to another company, your terms cannot change legally. So it's essentially, let's say Fairway gives you the mortgage, but then they sell it to Wells Fargo. Wells Fargo is only taking the payments. They're not changing any of the terms or anything.
Yeah, my original mortgage company is not the mortgage company that's holding my mortgage now.
Right.
There have been several changes to that over time.
And at a very high level, there's a whole investors market that goes into it. It's almost like buying a stock, right? So, if your mortgage does change hands, I wouldn't worry about your payments. They're going to stay the same.
So moving on, the mortgage rates are starting to stabilize. A lot of prediction that they're
Thank God.
that they're going to drop a little bit, and
Yeah.
everything's going to balance back out. Talk a little bit about an ARM.
An ARM. Ooh, nice curveball. Appreciate that one. So, for those of you who don't know, an ARM is an adjustable rate mortgage. And I know they get a lot of bad reputation out there, but it could be the difference between you getting into the $350,000 home versus the $400,000 home. Basically, an ARM in a nutshell, there is a, how can I explain this? A set term up front, and then after that term has expired, there is a variable term. So the goal for most mortgage advisors is to get you into the home for that fixed period of time. And then if that adjustable time pops up, we can always refinance into something, more less sensitive to the market.
I'm glad you brought that up, because I was going to take a step back. With a conventional mortgage, 10 years down the road, I can use the equity in my home. I can do a home equity line of credit, a HELOC.
Yeah.
I could also refinance down the road
Absolutely.
to get a lower mortgage rate. And I was going to ask, down the road, 10 years into an adjustable rate mortgage, can I refinance that? and go into a conventional mortgage.
Absolutely.
Maybe at that point go into a 15-year fixed rate mortgage to finish paying off
The initial
at an accelerated rate.
Yeah, of course. For those of you out there, a refinance is basically always an option. Now, whether it's beneficial or not depends on your particular situation. Yeah, to your point, if you do sign up for an ARM initially, there's always the option to refinance into a 30, a 20, a 10, whatever benefits you, the borrower, is what we will discuss when the time comes.
Because a first-time home buyer is typically fresh out of college, a young professional, or someone just getting established in the trades with a good job. So 10 years into that, 10 years down the road, you should be in a much better financial situation. Your student loans are paid off, debts are paid off, you've established some more savings, and again, your equity's up in the house, so you can do something like that. Talk a little bit about someone, not a young professional that maybe hasn't come out of college or has come out of college but via being a veteran, having spent time in the military. They would qualify for a Veterans Administration loan. How do they work?
Okay. VA. Good question, bud. So for those of you who are in college and who aren't veterans, we can use your 4 years of college education to qualify you for the job that you have currently taken.
That's a good point.
So if it's the same field, let's say you're a chemistry major, right? And you get a job at a biotech firm. Well, we can use that 4 years of school history as work experience. So as long as you have that contract in hand saying, hey, I'm going to get paid XYZ, we can help qualify that mortgage. And then to those of you who are veterans, first of all, thank you for your service. But we can use your VA eligibility. So if you have a stipend from the VA, or if, God forbid, you are on VA disability, there are certain perks that come along with that. So for the VA loans, there's 100% financing out there. There's reduced real estate taxes, or even no real estate taxes at all. Again, I always say every situation is different, so reach out. But just know that the options are out there for you.
Now, is someone that's active military would qualify still for a VA loan?
Absolutely, yeah.
But they would also qualify for a conventional mortgage or an ARM.
Correct.
Even, active military. The military is their employer.
As long as they're getting some kind of income, there's always a possibility of approval, whether it be VA or conventional. It really all depends on the particular situation, which one is more beneficial than the next. But yeah, I like to look at all options when discussing.
And that works for a husband and wife or a couple who are going to own the home jointly. If one is a veteran, they would still apply for. Or could apply and could be approved for a VA loan. Absolutely.
And the just to get into it, the rules on that is, as long as that veteran is the primary borrower on that loan, we can absolutely use the VA options or the benefits that come along with that.
That brings another question to mind. A couple that is not officially married.
A couple that is not officially married. We still talking VA?
At this point, any type of loan.
Sure. So
can you still combine both incomes as a household income? With both names on your mortgage and.
Yeah, absolutely. So for those of you out there who aren't married but are thinking about getting a mortgage together, we in the mortgage industry would consider them co-borrowers. So we would take a look at each individual separately. For those of you who are looking into VA options, the cutoff is marriage or a spouse. So you are allowed to have a co-borrower on a VA loan. Just know that there are additional rules that mortgage companies need to follow if you aren't officially married.
Perfect. Do you want to touch briefly on some of the other types of mortgages we discussed earlier? The FHA?
No, I don't. I'm just kidding. I'm just kidding. So FHA is a good one if you have less than perfect credit. I would say anything under a 720 or a 680, unless you have that 20% down payment. In that case, it is 3.5% for your down payment. They don't really care about blemishes on your credit. Just know that the private mortgage insurance, which is another factor in your monthly payment, that may go up or down depending on your particular situation.
And do me one last favor before we wrap this up. Just briefly outline for someone who knows they're going to be buying within the next year. What steps should they start to take before they come in to see you to get their ducks in a row?
So they're getting ready to.
They know they're going to be buying. They know they're going to be walking in for a pre-approval.
Sure.
It's some months off, 6 months off.
Yeah.
What can I do to make my credit better?
Gotcha. Cool. Good question, man. I really like this. So one thing you should look out for is to pay down all of your monthly debts, whether that be car payments, credit cards, personal loans, things of that nature. That is a huge factor in what mortgage companies use to pre-approve people. As best you can, get your credit as high as it can go. Whether that's, paying off a collections account or, things of that nature. Make sure you have a steady employment. Typically, most programs look for a year to 2 years of consistent employment. Now, those of you who are job jumpers, that doesn't necessarily mean that they're disqualified. It's just more paperwork on your end as the borrower to kind of put the pieces to the puzzle. And then, tried and true, just save money. The more you have to put for a down payment, closing costs, all that, the better you're going to be.
And one thing I'd like to add to that quick that I know from experience from working with you with clients, once you have been pre-approved for a mortgage and we're in the process of the home search, you do not want to be making any major purchases.
Don't go out and get the jet ski that you always wanted. Don't go out and get the $150,000 car. I can't tell you how many times people ask me that. If you're going to be buying a home, that's what you want to focus on. Absolutely.
So again, thank you, Brenden, for taking the time to be with me.
Hey, I always appreciate it.
If you're a first-time home buyer, or even this is your second or third home you're looking into, even considering renting, want to compare renting with buying a house, reach out to me. Brenden and I will sit down with you one-on-one, go over everything in detail, and map everything out for you. So I look forward to working with you. Brenden, thank you.
Always a pleasure, Mike.